Good morning, welcome back. So I'm putting this video together for homeowners who maybe have bought homes in the last couple of years and maybe they had a variable rate mortgage, and now with what's going on with the Fed and the Bank of Canada, they're seeing those mortgage rates and mortgage payments just absolutely go through the roof. This was kind of semi-foreseeable, but let's not get into that. It's the rate of increase that is concerning and that is affecting a lot of people. Everyone knew rates were really, really low and that maybe they were not going to stay there for that long, but it is unprecedented the rate in which the Bank of Canada and the Fed are actually increasing those rates. And in terms, it's this uncertainty about future rates that's making it so that all the mortgage rates are just absolutely going through the roof. So I'm going to jump right into it. There's a couple things I want to go over, but it's basically going to be how mortgage payments are calculated, what you can do to reduce your mortgage payment if you have bought in the last couple of years, and maybe you were on a variable, but now you're seeing those rates really, really bump up, and you want to, well, you might be scared. You want to make sure that you have a payment for you that is going to be manageable, that you can see covering in the future, because no one likes the uncertainty of knowing what exactly they're going to owe at the end of the month to cover their housing and their shelter. So, mortgage payments are amortized, and what this means is that when you make a purchase and you get a mortgage, say you have a $600,000 mortgage, you're going to amortize it. And that just means that with your principal, which is the $600,000, you're going to come up with a payment that is also going to cover the interest on that loan, but at the same time, there's going to be enough left over to pay off the principal of the loan. And the amortization is the time it's going to take at that payment to clear that debt, as well as any outstanding interest associated with that. So say you have a $600,000 mortgage and you have a 25-year amortization, your interest rate's 3%, and your mortgage payment is, not too sure off the top of my head, but say it's $2,000. So that means that for 25 years, you're going to make a $2,000 payment every single month, and at the end of that 25 years, that very last payment is going to completely clear the balance of what you had owed, and now you owe the property outright. So, with the 25 years, that means that your payment is going to be higher than, say, if you had 40 years to pay it off. That's why amortization is a very important factor in terms of what your monthly payment is going to be. So for those that bought in the last couple of years, a lot of lenders, at least in Canada, would offer, some offered all the way up to 35-year amortization, but the most common amortization is 25 years, and that's the amortization that most people would be getting from some of the big banks. So if you bought a property and you have a 25-year amortization, and say you put a decent amount down, say 15, 20%, you will actually have the ability to go to a lender. It could be your bank. I personally would recommend speaking to a mortgage broker. That's going to be highly recommended, because mortgage brokers are going to have a bit more tools on their tool belt in terms of helping you find the right loan that suits you. There's nothing wrong with banks, but banks really do deal with a very specific clientele, and if you don't fit into that bracket or fit into that little very narrowly defined borrower, then they're not going to be able to help you. So first, I'd recommend speaking to a mortgage broker and having them pull up your file, pull up your property, and really seeing what can be done, because there's a possibility that you could take your 25-year amortized loan and stretch it out to 30 or maybe 35 years. And that's going to help you drastically with your monthly payment. Now, I wouldn't recommend, say, sticking with the 35 years. If you can pay it off in 25 years, that's great. But it doesn't hurt to get a 35-year amortization and then just increase or double up your payments to then bring your amortization back in line, because a lot of lenders are going to allow you to prepay. But what this does is it gives you the flexibility to pay less in case you ever had any sort of cash shortages, which today, with the rising increase of gas, food, everything, it's always good to keep more cash in your pocket as opposed to have high liabilities that you're going to have to take care of every single month. I have set up a mortgage calculator. I'm using a $600,000 balance for all three scenarios. Scenario one is going to be our base case, what a buyer started with. say they were paying $25.41, they were happy, they had set their finances based off this, and everything is great. Now, upon renewal, with what's going on with the massive increase in interest rates, say their mortgage rate that they started with was 2%, but upon renewal, they're facing a 4% interest rate. Now, mortgage rates are even higher than 4% now, but let's just assume that upon renewal, their mortgage rate is double their initial contract rate to show what the difference in payments is. So that would mean that if they were to renew their mortgage, their payment would jump from $25.41 all the way to $31.56. And for a lot of people, that's going to mean that they've got to throw in the towel, sell the property, or do some drastic cutbacks to their personal spending habits. Now, for scenario 3, you can see that the payment is $26.45. This is actually the same balance, $600,000 mortgage. However, the only difference I've made is push the amortization out to 35 years. And this is giving them more time to pay the loan. You are going to have an increased aggregate interest cost over this term, but at least it's going to mean that instead of this massive increase from $25.41 to $31.56, they'll see an increase of just over $100, which I think is absolutely amazing considering their interest rate has gone from 2% to 4%. Now, a lot of people took HELOCs, and what HELOCs are, or their home equity lines of credit. Now, HELOCs were really cheap at the time when the interest rate was near zero. But unfortunately now, because of interest rates going up and going up so quickly, they are starting to get pretty expensive, and there were a couple different lending changes in Canada through the banks that mean that you can no longer just pay the interest payments on some of those HELOCs. So now, unfortunately, you're going to have to amortize that, which means that you're going to have to make a payment that's going to cover interest, plus pay off a bit of the principal every month, and that plus the increase in the interest rates is not very good for a lot of people, because at the same time they're seeing all of their other costs for living increase, they're seeing the mortgage interest payments increase, they're also now seeing their short-term debt or HELOC payments increase. So what you can do if you're someone with a large balance on a HELOC and those payments are really starting to get to you, you can speak again with either a bank or a mortgage broker. Like I said before, I would personally recommend a mortgage broker about rolling the balance of your HELOC into your mortgage. And what that's going to do is that's going to mean that instead of you having a very short-term amortization on a HELOC, which might be 10 years, you can take that debt, roll it in, and then put it, say, at a 30-year amortization and really reduce your monthly expenses. Those are two of the things that you can do. If you're someone who has a biweekly accelerated mortgage, I would definitely speak to your lender about switching to monthly, which is again going to reduce what your outflows are going to be. But those are pretty much the two things that you can do to reduce your mortgage costs and to make it a bit more manageable this period where it's very uncertain what's going to happen and where rates are going to settle. But it's important that you know exactly what your debt obligations are going to be in the near term. And these are a couple ways that you can reduce those debt obligations, keep more cash in your pocket for an emergency fund, and overall just deal with the stress of today a lot more certainly.